Welcome back to FX Limit. Today, we're diving into the top 5 fundamental factors that influence currency valuations. Understanding these factors is key if you want to trade Forex with confidence, especially in a market that moves fast and rarely forgives mistakes. Let's get into it. First up, interest rates. Central banks like the Federal Reserve or the European Central Bank adjust interest rates to either stimulate or cool down the economy. When a country's interest rates rise, foreign capital usually flows in, chasing higher returns. This boosts the demand for that country's currency, pushing its value higher. On the flip side, lower interest rates often lead to capital outflows and weaker currencies. Forex traders keep a close eye on interest rate decisions and the language used by central banks. Even the tone of a statement can shake the markets. Next, we've got inflation. A moderate level of inflation is usually considered a sign of a healthy economy. But when inflation gets too high or too low, it affects purchasing power and investor confidence. If inflation is high but the central bank is expected to respond with rate hikes, the currency may strengthen. But if inflation spirals without action, confidence crumbles and the currency suffers. Tools like the Apex Trend Indicator can help traders stay ahead of these shifts by identifying trend reversals early, especially when market sentiment changes after major inflation data is released. Third on the list is economic performance. Think GDP growth, employment numbers, retail sales. These data points reflect the health of an economy. A country posting strong numbers usually sees its currency gain in value. That's because stronger economies attract more foreign investments. Traders look at the economic calendar religiously. When positive data comes out, currency values can spike within seconds. That's where having a reliable system like the Apex Trend Indicator really helps. It alerts you to potential trade opportunities right when these events hit. Number 4, political stability and geopolitical risk. Markets hate uncertainty. Political unrest, elections, or geopolitical conflicts can cause traders to flee to safer currencies like the US dollar, the Swiss franc, or the Japanese yen. The more stable a government and its policies are, the more attractive its currency becomes. For traders, this means staying updated on world news and having tools that quickly adapt to sudden changes. With real-time signal alerts, the Apex Trend Indicator lets you react quickly without getting caught off guard. And finally, we have the trade and current account balances. If a country exports more than it imports, there's generally higher demand for its currency. A surplus in the current account usually supports a stronger currency, while a deficit can weigh it down. Traders analyze these numbers to gauge long-term currency direction. But interpreting this data and knowing when it's actually affecting price can be tricky. That's why many rely on indicators that aggregate trend data across multiple pairs and timeframes, like Apex does, so they don't miss the bigger picture. So, there you have it. 5 powerful factors that shape the Forex market. Understanding these fundamentals is crucial, but it's only half the battle. The real edge comes from timing. You need to know not just what's moving the market, but when. That's where tools like the Apex Trend Indicator come in. It combines advanced algorithms with real-time trend scanning to show you when to buy or sell across any pair or time frame, with signals you can trust. It doesn't repaint, and it even sends alerts straight to your phone or desktop. Whether you're a seasoned trader or just getting started, combining fundamental knowledge with a reliable trend indicator can take your trading to the next level. Thanks for watching FX Limit. Don't forget to like, subscribe, and hit the bell so you never miss an update. See you in the next one.